Well, good morning. Welcome to the Hump Day opening playbook. That's what we call Wednesday here in America because it's the middle of the week. Happy Hump Day. All right. Hope everybody's having a good morning or whatever time of day it is where you're joining us from. Let's see what's going on. We're going to get into just a couple minutes of pre-show content to let you know what's coming up, and also for everybody here that's new, just give them a little intro to what's going on, and then we will get into a lesson and an introduction for those who don't have it to one of Nathan's programs. So let's get started in just a minute. Good morning, Silvana. All right, I'll get started. So, for those that are brand new, Opening Playbook is a free daily webinar that provides timely market reviews and trading education. We focus on market overview, trade ideas from Nathan and Graham, daily Q&A with you, live trading on occasion, and special guests on occasion. We don't focus too much on the trading, like actually taking trades at opening playbook, but we do have a closing playbook session at 3:30 p.m. Eastern time where we focus more heavily on end of day trades. When you come to this room, you may see this join the chat screen. Please do not click on log in here if you see it. We're taking that away. That shouldn't be there. You just need to type in what name you'd like to be known as in the chat and click join, and you're in. You can click the hamburger menu, those three lines on the top of the screen, to shrink the left column and give yourself a little more screen real estate for the video presentation. When you hover over or tap on the video, depending upon your device, you'll see a speaker icon in the lower left. That's your mute and unmute button. So if you have trouble, like if you don't hear anything with the video, go ahead and click, double check that, make sure you're not muted, and turn the sound back on if you are. In the lower right corner, you'll see a couple of icons that let you control the size of the presentation. The double arrows will make the presentation full screen, which will hide everything else, but let you see what's being presented as large as possible. And let me go back to that. Sorry. Well, my bad. I'm jumping all over the place here. The other icon next to that, the square in a square, that's the picture in a picture. And depending upon what device you're on, what that'll do is that may be there or may not be there. And what it'll do is shrink the presentation into a small box so that you can work behind it. So, for example, if you're only on one screen and you want to be able to flip to your brokerage account and do something in there while we're talking about it, you can use the picture in a picture. Now, it does depend on the device you're on and the browser you're using. Chrome, as the browser, seems to have the most success with the picture in a picture. So if you're interested in that feature, try using Chrome. Underneath the video, there's a little slider called low latency. And when that is yellow, it means it's on. And I recommend that you turn it off. You'll get a better video and audio quality with it off. It just means that you're seeing what we're saying and doing just a few seconds delayed so that it has an opportunity to give you the best quality presentation. And in the chat, when I post or Nathan or Graham posts in the chat, you can hover over or tap on any of our posts in the chat, and then you'll see some icons appear, and you can click on that double speech bubble icon to private message any of us. And that'll be a message that only we can see, whoever, whether it's my message or Nathan or Graham's, whoever you click on, will be the only one who can see your message. And that way you can ask a question in private. You can give us your personal information so we can look up your account or give you a call, any of those types of things without the whole group seeing it. Today in Opening Playbook, Nathan and Graham are out again for the second morning in a row. This is their last outage, so to speak, for company meetings that they're in. We're going to play a replay of Nathan's recent lesson on debit spreads. He did it at the beginning of August. And so if you missed it, you'll get to see his lesson on debit spreads. Even if you saw it, it's a great lesson. It's an awesome reminder about how debit spreads work, how to calculate risk and profit potential and cost and all of that. And since Nathan and Graham do a lot of debit spreads, this is a really valuable lesson to have going into any of their trading programs. And then for those that don't have it, we're going to do an introduction to Nate's overnight options program, which is a very popular program of his. Trades 4 days a week, Monday, Tuesday, Wednesday, Thursday. So today is Wednesday, and there'll be a trade on overnight options at the end of today. So an opportunity to learn about that program, get in it if you want to at a discount for being here on Opening Playbook. And, we'll go from there. So that's all I have for you. We'll get started in just a couple of minutes. I'll see you back then. Hey, I'll also mention for those of you who may not have seen it before, under the video, there's an announcements section. If you scroll down, you'll see a whole bunch of helpful links. And the first link on that list is the link you should be using to get into Opening and Closing Playbook every day. Just in case anything changes on our server or anything like that, that link will always get you into the live events. And then if you want to see a replay of yesterday's opening or closing playbook, that second link in those in the announcements there will be a replay of yesterday's opening and closing playbooks, and that'll continue to get updated. So this afternoon, you'll be able to see a replay of this session and so on and so on. And there are a number of other helpful links in there. I suggest you take a look through there. And if you don't have any of those things, grab those links. All right. Let's get going into the Opening Playbook theme song.
Flip the page, it's time to start the game. Graham and Nathan calling out the names. Opportunities knocking loud and clear. The market's playbook is finally here. Opening Playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like the razor blade. This is where the big plays are made. Oh, charts are lighting up the morning sky. They spot the trends with a hawk side. Options and plays in a live display. This is where the big plays are made. Oh, charts are lighting up the morning sky. They spot the trends with the hawk side. Options and plays in a live display. Every move counts in the game they play. Opening Playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like the razor blade. This is where the big plays are made. Oh, step by step they break it down. No confusion, no spinning around. With every trade they set the tone. Making big calls from their trading phone. Opening Playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like the razor blade. This is where the big plays are made.
All right. Welcome to the Wednesday morning opening playbook on August 27th, 2025. Happy hump day. Getting over the hump of the week here. Just looking in the comments here. Polly, I'm not sure what why you're having trouble with the links, but please, everybody else, the links in the announcements are correct. The marketspg.com/nmc-live will take you into this room. And the reason we give out that link instead of the link that Polly posted is because it will always go to the live room, whatever configuration we have on our server, that will take you into the live room. So please use the links on the left. Let's see. Given some time on the overnight options, it looks like to fill. All right. So for those just joining us and not here for the pre-show, we do a little bit of bonus content about 10 minutes prior to official start time. So if you want to come a little early at about 9:50 a.m., we do kind of a run through of the platform and what's coming up in opening and closing playbook. So if you're available to show up a few minutes early, you can always do that. We also talk about some of the helpful links and some of the other things going on. So if you're available to show up a few minutes early, it's always advised. Of course, we do have people coming in whenever they can, which is fine. We are going to get started in just a second. Nathan and Graham are actually out again this morning. This should be the last time that they are out due to company meetings this week. They will be back for closing playbook today at 3:30 p.m. But we are going to show you a replay of Nathan's lesson from earlier this month on debit spreads. Now, even if you saw it, it's probably worth watching it again because this is a very integral part of how Nathan and Graham both trade. Many of their programs involve debit spreads, and really understanding how they work, how to calculate their cost, how to calculate your risk and your profit potential. All of that is really important to many of their programs. And of course, it's in their trainings and stuff like that. But this was a very recent, up-to-date review on how debit spreads work. And I think is important for anybody who's in either of their programs, as well as just doing any kind of trading, to really understand the pros and the cons of debit spreads and how they compare to credit spreads as well. So we're going to go ahead and get started with that in a second. And then after that, for those that aren't in it, we're going to do an introduction to Nathan's overnight options program, which trades 4 days a week at the end of each day, Monday through Thursday. So if you want to get into that program this morning, you'll be in it for this afternoon's trade. So let's get started with the debit spread lesson. And I'll be here in the background. If you have any questions or need anything else, go ahead, drop it in the chat.
Let's start. If I flip this forward, you guys should now see our agenda on the screen here. So today today is a deep dive into debit spreads, how they work. I'm going to give you some actual live trades in multiple different brokers so you can see how they actually are executed, understanding risk exercises and expirations, early exits, should you use a stop loss, and more. So we've got a lot to cover. But first, let me just confirm that you guys actually see my screen flipping, and you now see the slide that says today we'll cover with all those bullet points that I just mentioned. Is that screen flipping and coming through clearly on you guys' video? Yes, yes. All right. Perfect. Beautiful. All right. Well, good. Well, it looks like we should be rolling then. And yep. Okay, cool. All right, guys. Well, let's jump in. So I'll just give you the quick preface that I personally think that this training is probably the most foundational, fundamental training to the way that I do things. A lot of what Graham is doing falls in this category of how these kind of trade structures actually work, the benefits of them, why we use them versus regular options. And so what I'm going to try to do today, I'm going to try my very, very best today to give you guys both the conceptual framework so you understand the advantages and the conceptual idea of trading this way, and then also get into the very practical benefits of trading this way as well. So that's what we're going to do. I hope this is beneficial. If you guys have never kind of gone through the deep dive of how these debit spreads work, then I recommend you take notes or simply join Opening Playbook VIP for $1, because then you'll get the slideshow presentation and all that sort of stuff with it as well. So let's go ahead and dive right in. I'm not going to pay as much attention to the chat over the next 40 minutes or so here. I'm going to mainly focus on the presentation, and then we will dive back into the chat later, but I'll try to keep somewhat of an eye on it in case anything goes awry as we're testing the new platform. And I'll let Graham jump in if anything's broken or not coming through. All right, so what is a debit spread? A debit spread allows us to take a trade with less overall risk and a higher probability by simply buying and selling an option at the same time. Now, anytime we trade a debit spread, we are creating what I call a line in the sand. So that's a strike price. That's a certain price on a particular stock at a particular time. And that's where the expiration date comes into place. If you guys have ever traded an option, it's going to have a strike and it's going to have an expiration, right? So that line in the sand, that's where your strike price comes from, and how much time you have is that expiration date. For example, if you take a chart like this, most people buy call options where the stock has to go up to make a profit on the trade, or they buy a put option where the stock has to go down to make money. And the challenge with buying regular options is that you're battling timing and direction and implied volatility all at the same time, which means you don't just need the stock to go up. You actually need to go up a lot at the right time, and then you need to make a great exit on the trade. And I always ask, how many of you guys have ever made great trades, but then you don't get out at the right time? So your entry might be good, your direction might be good, but then your exit is actually what hurts you. I'm seeing a whole bunch of chat saying that the overnight option trade hit as well. Awesome. Love it. Another win on overnight options. We'll talk about that shortly here as well. But how many of you guys have made a ton of great trades with great entries, but your exit was not good enough to make you a profit? Anyone been there, or is that just me? Right? That is a major, major challenge with trading, which is why some recent studies suggest 90% of regular option buyers lose money. Wow. 90%. That's a crazy, crazy number of regular option buyers losing money. The way I trade most strategies is almost the exact opposite. Remember, a call option has to overcome that certain area just to have a chance at a profit, and that's called the implied volatility. That's what you're paying for in the volatility. So while you might be entering the trade down here, your line in the sand to make money, where you actually need the price to go, is up here. And you have to time the significant move up with really good timing as well. What I'm doing is flipping all of that around and using a line in the sand wherever I want. And that's really important, guys. When you're trading a debit spread, you can actually pick the line in the sand wherever you want, right? So you're not at a whim of where the market needs to go. You're actually telling the market where you want it to go for you to create a winning scenario. It could be above the price for a directional debit spread with a big ROI potential. This would be like an elite trade or a jump trade where you're making the market move a lot. Or it could be well below the price for a defensive trade with less ROI potential. So this might be something like the income machine trades, where you're getting more conservative below the price. What this means in practice is that if the stock hits the expiration anywhere above this level, the trade is a win. So that's what actually a debit spread, the win-loss scenario in very basic terms, is it has to finish above that level. You're creating your winning zone anywhere above that on a call debit spread like this. A put debit spread with the line in the sand would work the same way, but in reverse. Anything below the profit zone for the trade would be a profit. So the key here is that we're creating a ton of winning scenarios when we choose a line in the sand versus having to get the timing and direction and the exit all right together. Nice. Jack, Linda, more overnight option winners. Love to see it. So in a bullish example with a line in the sand below the price can go up, price can go sideways, price can go down a little. It can even go down a lot and then bounce back and finish above the line in the sand, and we still win the trade. So again, we're talking about more scenarios that provide winning opportunities. Okay, remember the first scenario is a call option. It has to go right in your direction quickly, all at the same time. You have to get out at the right time. All that has to happen. Here, there's lots of different scenarios where you can end up with a winning trade. And here's the cool thing about debit spreads. Whether we nailed the direction and the stock finishes way above the line, way up here, or barely above, all the way down here, or somewhere in between, it actually doesn't matter for a debit spread. We get the full max value in every situation as long as it's above our line in the sand. And there are three main components to building out a trade like this. Where do you put your line in the sand? So where on the chart are you actually trading it? How much time do you give the trade? That's the expiration date. You know, how big of a window of time? And then what is the risk to reward you get with that combination, which I personally think is the part of the, the combination that most people ignore. Most, trading gurus out there, they kind of ignore the realities of the risk to reward and what the trade-offs are from trading that way. But we want to talk very specifically about that because it's arguably the most important part of the entire structure of the trade. So you could go below price, like I usually do, where you have a 1% cushion or a 3% cushion or a 10% cushion, or you could go above the price with the exact same structure. In either situation, okay, this is important. Either situation, the principle is the same. The stock has to finish above the line in the sand that you're choosing to yield a full profit. In one case, you're starting with the price already above it. Okay, so you're already starting out with the price above it. In the other case, you need the stock to make a directional move to get above the line in the sand. Okay, does everyone see the difference? The reality is the exact same. The market has to stay, or finish above that line. In some situations, you're starting out with it already above the line, so the stock can do nothing. But in other situations, you're actually creating a line in the sand where the market has to make a net move above that line in the sand in order to be above it. The principle is the same. The stock has to finish above the line in the sand at your expiration date, but in practice, how it actually works is different, where one, you're already below it, and the other, you need the stock to make a move. So your next question should be, what does finish mean? Nate, you keep saying it has to finish above the line in the sand. What does that actually mean? Well, that's where your expiration date comes into play. And you can pick any combination of line in the sand and expiration date that you want. And that's going to determine what your profit potential actually is. So these combinations are really where the magic happens, right? Because you're going to choose, where do I want the stock to go and how much time am I giving the stock to make the move? And the combination of those two things is where you're actually going to see what kind of trades and what kind of risk rewards you can make. So you can have a 50% ROI potential if you gave the trade, 7 days and a 1% cushion, maybe 50, 55% ROI. Or if you actually flipped it and said, instead of having a 1% cushion, I actually wanted to move up 1%, you could flip that from a 55% to 125% ROI because you're requiring a directional move. Or you could give it 21 days instead of 7 days, and now your ROI potential might go from 125% down to 105% because you're giving it a little more time. Or you could be really safe, where you go 8% below the current price and you only give it 7 days to make that move. But you could also give it 35 days, and now you're going to get more bang for your buck because you're giving the market more time to move negative 8%. So why does that happen? Okay, look at this. 7 days, if it moves down 8%, you can make about a 5% ROI on the potential. But if you keep the line in the sand exactly the same, but you trade 35 days away, now the market's going to give you 25%. So it's going to give you 5 times the profit potential, flipping from this scenario, 7 days and 8% cushion, to 35 days and 8% cushion. Why does that happen? Well, because the market's not dumb. It knows that it's very unlikely that a stock's going to move down 8% in the next 5 days. You're almost guaranteed to win that trade. But when you give it 35 days, the market automatically prices in that there's now a higher likelihood that the market is going to move down over the next 35 days, 8% than it would in 7 days. And it's automatically reflecting that in the price of the options. And that's why your ROI and your risk reward is going to change. Okay, so now hopefully you have a good conceptual understanding of building that line in the sand with a debit spread, right? Like you can pick your line in the sand, you can pick your time, you're going to get different ROIs. It's going to have to finish above that line in the sand. But what are we actually doing when we set up the trade? Bob, if you're getting an echo, it probably means you have it open in multiple tabs versus just one tab. So you probably have the opening playbook room open in 2 different places, and that's probably why you're getting an echo. So a debit spread is an option strategy where you buy one option and sell another option at a different strike price, both with the same expiration date. You pay a net debit, that's a cost to enter the trade, and your risk and reward are different, are defined from the start. So you always know how much you can make versus what you can lose right from the initial setup of any debit spread. So for example, imagine the stock's trading at 110, you buy the 109 call for $1.20, and you sell the 110 call for 45 cents. So your net cost is 75 cents per contract, right? Because you bought one, you sold one, you pay the difference. Now the max value of the trade is $1. So the most you can make, or the most it can ever be worth, is $100 per contract, right? So your max profit, your actual net profit on the trade is going to be $100. That's the max value minus what you paid, which in this case, our example, $75, right? So your return here is the $25 that you can make versus the $75 that you paid, which is a 33% ROI. Let me just pause there. Does that make sense to everyone? You have a price that you paid. Give me a yes in the chat if it makes sense. You have a price that you paid. You have a max value that it can be worth, and you're simply going to divide those together to actually get a real ROI, just like our overnight option that a whole bunch of you hit yesterday. So we paid a certain price. We paid like 70 cents. The most it could be worth is $1. So 30 divided by 70, we're going to have like, a 30+% or 40% ROI. Then we use a target for a portion of that profit, which we'll talk about in a minute. Okay, good. Perfect. So almost every broker will allow you to do what I just described in one ticket or in one trade using a vertical spread. I'll actually show you an example from several brokers here in a minute. Now, for a call debit spread, which is what I'm doing 99% of the time, it's always going to look something like this. You're going to have a current price, where it's trading, and then you're going to set up your buy and call option somewhere relative to where the current price is. In this example, we're saying the current price is 101. I'm buying a $99 call. I am selling a $100 call, and that defined together is my debit spread. Now, the option we sold is what I call the line in the sand. So if you're taking notes, this is probably one of the most important notes to take. When Nate says line in the sand, where the price has to finish, what does that mean? It's the sold call option at the higher price. That is the area that we must finish above to get a net profit. Okay, that's what was going to generate the max profit. But what is the max profit? How do we know what we're risking and what we stand to make? And again, this is the part that I think most people kind of skip over and never really explain in detail, because that just sounds nice to say, hey, look, you made $20 or you made $30 or you made 20%. And they don't really explain how this actually works. So in order to do this, you have to know 3 things: the max value, what you're paying, and the potential reward. Now, the max value of the spread is always the width of the spread, which means the difference between the strikes. So on a trade like this, where you buy the $99 call and you sell the $100 call, since that's $1 apart, the max value is equal to $1. If we were to instead buy the $990 call and sell the $1,000 call, now those two strike prices are $10 apart. So the max value becomes $10, not $1, because the strikes that we're doing our debit spread are $10 apart. If we were to buy the 270-250 and sell the 275 call, now those are $2.50 apart. So the max value there is $2.50. As long as you know the max value of the spread, everything else should start to make sense to you, right? For example, if I buy the $99 call and sell the $100 call and I pay 80 cents for the trade, how much profit can I make on the position? Well, we know what the max value is, so now everything should start to make sense, right? Jack and Wayne, you guys are on the ball. We have our max potential is 20 cents. Why? Well, because the max value is 100 minus 99. That's $1. I paid 80 cents up front. So if it becomes worth $1, if it hits that max value, I will have made 20 cents, which is equivalent to a 25% ROI. Okay, Karen, this is the same principle for anything. Whether it's a wrap, whether it's a jump trade, whether it's a defensive trade, does not matter. The math is all going to be the same. The structure is all going to be the same. The difference is going to be where the strikes are and what you pay. But the formula is going to be the same for every debit spread, regardless of whether it's a wrap order or a jump trade or defensive trade or anything else. Same thing on a wider spread, right? If I buy the 270-250 and I sell the 275 and I pay 125, what's my profit potential on that? No, Jacqueline, it is a 25% ROI. So this is actually, Jacqueline, something that a lot of people get wrong. I actually have heard professional traders teach this and get it wrong. That silly little math gets you. So people will say, hey, it's $1 spread and I made 20, so that therefore I made 20%. You guys see the problem with that logic? And by the way, I've heard people who have been trading for 30 years explain it this way and say like, hey, I got a 5-cent credit on $1 spread, therefore it's 5%. I got a 30-cent credit on $1 spread, therefore it's a 30% ROI. But there's a major problem with that. They're giving you the full width of the spread, not your risk, not what you actually paid for it. The risk that you actually took on was the 80 cents, not the dollar. So you're always dividing your profit potential versus what you paid and your risk. And that's where the 25% ROI comes from. So Jacqueline, hopefully that makes sense. A very, very common misconception that so many people get wrong here when they look at spreads. They do it based on the width of the spread versus the actual risk, which gets really, really wonky when you start doing examples like the next one. Paid $1.25, and so what's your profit potential? Well, it's 100%. So I've heard tons of people say, hey, I got a $1.25 credit, or I made a $1.25 debit, or whatever you want to do based on the 250 spread, so I made a 50% ROI. And you have to say, whoa. No, you made 100% ROI because you only risked the 125. The 250 risk was never in play. And so if you think about it, they run their math on making a 50% ROI and they think, it has, a 58% win rate, but it's a 50% ROI. That's not profitable. And you have to say, no. You made 100% ROI. So if you can win 60% of the time with 100% average ROI, that's a phenomenal strategy. But they get it wrong because they're looking at the width of the spread instead of the actual risk to reward, the true risk to reward. So hopefully that makes sense. Like I said, this is the part that most people skip over. It never gets explained. It gets missed all the time, even with talking heads and people who should know better. And so hopefully that's a little bit of an aha moment for people. So again, as long as you know the value and the potential of the spread, you will always be able to understand your risk to reward. So with that being said, pop quiz. If I have a massively high probability trade to buy the 230 Apple call and sell the 235 Apple call for a $525 debit, and I'm basically guaranteed to win the trade. Should I take the trade? Right? And unfortunately, I've seen people do this. But you guys are right. Why should I not take the trade? Well, because the max value of the trade is only $5. So if I pay $525, I'm guaranteed to lose the trade. But unfortunately, I have seen people put a market order in and pay more than the max value of the trade. But if you have a real understanding, you won't be caught in that trap. You won't just be following an alert blindly and pay too much for a spread. You'll know, hey, looking at this, the max value is $5. So I'm never going to pay more than $5. In fact, I probably won't pay more than $4.50 because I want to have at least 10 or 12% ROI, even on a high probability trade, right? So hopefully that is starting to click for you guys. All right. So now you should have an idea of the conceptual structure, how we want to set that up, and the function of the options themselves. But you still may be wondering what actually happens when a stock finishes above the line in the sand. So we've already covered a lot of math. Who's ready for some more math as we get into what actually happens? Because this is another question. I get this one in my email almost every day. Okay, Nate, you said I'm going to win if it finishes above the line. How do I win? What the heck actually even happens under a winning scenario? So we have all these great scenarios where we can make money. What actually happens? Well, like I said, anytime the stock finishes above our line in the sand, we win the trade. But what does that actually mean? Well, let's assume we set up the trade like this. We buy the June 27th $100 call, $99 call, and we sell the June 27th $100 call. So basically, we set up the trade over here with our line in the sand below price. So we have a 2%, what I call a cushion on the trade. We always use the same expiration date, June 27, June 27. And we're always using the same type of option. Both are call options. And when any of these outcomes occur, the trade expires in the money. What does in the money mean? It means above that sold call option and above that bought option. So both are in the money, right? Here's what that means. Our ability to sell the stock at $100 is exercised or assigned. You might need to use the word assigned. And our right to buy the stock at $99 exercised as well. So what happens when these both finish in the money is that your right to exercise and your obligation to sell both happen on the same trade. So all we have to do is a little basic math. What happens if you buy a stock at 99 because that's what your bought option, and then you sell the stock at $100? I mean, unfortunately, this is not rocket science on this particular math equation, right? I think everyone can get this one right. If I buy a stock for $99 and I immediately sell the stock for $100, what just happened? If I buy 100 shares, if I buy 1,000 shares, all the same, you make $1 per share, right? And that's actually exactly what's happening when a debit spread is exercised. What it's doing is it's giving you the stock at $99 where you buy it, and then it's selling it right away at $100. And so in practice, that's exactly what a debit spread is doing. So you're making the full value when these both exercise. Then you certainly just subtract what you paid. And like Christine said, maybe some fees, but that's where you get the net profit. So you make the full dollar minus the max value of the spread you create. And the best part, this happens automatically as long as your trade finishes above the line in the sand. So if you guys are wondering, okay, how do I get the broker to exercise it? What happens here and there? Well, this happens automatically if you let it expire above the line in the sand, meaning you don't have to do anything, no exit or trade management to collect the full max profit. All right, so we just covered the conceptual idea of how you can set up a spread and different risk rewards. We just talked about how to actually understand the function. Then we talked about the risk to reward. And then we talked about the actual what happens when it makes a expiration above that level, the actual exercise. Hopefully, that now all makes sense to everyone, at least at a fundamental value. Now, at a fundamental standpoint. Now, you might need to still make some trades because, in my opinion, it doesn't really start clicking until you've made a few trades, you've managed a few trades, you've watched them work out. But hopefully, you guys at least have a good framework. Give me a yes in the chat if you have a better framework for debit spreads now than you did 30 minutes ago. Hopefully, the answer is yes for everyone in the chat. All right. Good. Okay. Perfect. So, what you will see me do is go back and hammer these core ideas over and over and over again throughout time. The line in the sand, the risk to rewards, understanding the max value of the trade, all that sort of stuff is what I'm going to hammer over and over again with all the different trade structures that I trade. So what I want to do next is I actually want to jump into the brokerages and just do a couple dummy trades for you guys with real money. So not really dummy, but one contract example trades. And then I want to point you to some other really important topics, like why we often use early exits. I think one of the biggest advantages. What about early assignment? Green Farm Cat just asked that question. What about early assignments? Talk about, I'll point you to that. Why not credit spreads? And I think one of the biggest myths in all of options trading. And then really importantly, why I never, ever, ever use a stop loss, even though some of you get mad at me sometimes for not using a stop loss. I'll never do it on a debit spread, and I'll point you to that a little bit as well. But before we get into that, let me walk you through the actual trade here on a couple different brokerages. So let me stop sharing this. And what I will do is I will actually pop open my brokerage account here. And I'll start sharing that screen from the trade menu. Let me just share the whole window with you. You should see that. All right, folks, that is now sharing right there. And you guys should actually see my Thinkorswim platform now. All right, so like I mentioned, almost every single brokerage will let you actually do this in one ticket. So most of them will have something like a vertical pre-built option here. So regular options would be single, but then if you flip to vertical, like I do on Thinkorswim, you should be able to see that. Now, I don't know if I can write on my screen here. Can I write on the screen? Do you guys see it if I write it? I don't think it actually shows up, unfortunately, because of the way the sharing works here. But hopefully you can follow my cursor well enough to see up here is where we're going to choose the vertical versus all the other kinds of options. And that's what's going to pre-select these debit and credit spreads. Now, when you look at the actual framework of the trading options, what you're going to see is actually exactly what we just described. We talked about choosing your time frame. That's the expiration date, right? You can choose any time frame you want. You can do 2 days, 9 days, 16 days, 23 days. This is particular on Apple. And then within the time frame, you can choose, do I want to be below price or above price? And that's where your strikes are. The difference is these are going to be preset for you. So if I click over here, this is the 202.50, 205 Apple option, and I click that, it's actually going to pre-select buying the 202.50 and selling the 205 versus me clicking those options individually. Okay, so we could do an example of one of these trades here if we want. We could go to SPY, and I'll show you an example. So let's talk about if we wanted to do a very extreme option. Well, if you want to do a very extreme option, what you would do is you would give the option very little time, but you would require it to move a lot. So I could say, listen, I want SPY to move $5 today by the end of the day and go to the 634, 635, and you can see that option would cost me a whopping 1 penny. Why? Because that time frame I showed you earlier. If you give it 0 time and make it move a lot, you're going to have a very cheap option. If you give it lots of time, it's going to be a little more expensive. So I could trade this 634, 635 for about 1 or 2 pennies. So let's just to give you an example, I'll put that trade in, but my max loss would be $20 and my max profit would be $980. Why? Because the probability of the SPY finishing above 635, which would be our line in the sand here, is an incredibly slim probability. So let me go ahead and send that out. And there you go. I just got filled on a 634, 635 ridiculous spread that I don't recommend you guys taking for a 0 expiration, where the market would have to go up almost a full percent there over the next, what would it be, 5.5 hours in order to get above my line in the sand, right? So that's an example of an extreme. Now let's go to Tasty Trade here, and I will give you another example of doing this. Let me see. Actually, I think I have to switch my my window here again. Let me go to this. And I will just share the full screen with you there. Okay. So now I'm going to show you on Tasty Trade. I just put about $2,000 in a Tasty Trade account so that you guys can see that. Let me just refresh, because I had a whole bunch of questions from people who said, hey, I want to see this on a Tasty Trade account. So I put about $2,000 in here so I can show you trades on this. So same function, right? You go over to trading. You would pick which asset you want to do. See, it's asking me if I want to torque because it knows I still have no idea what I'm doing in Tasty Trade, but that's okay. And then under the trade tab, we would have the same kind of options, right? We would have what expiration do we want to choose? And then what strikes do we want to choose with that? Now, Tasty Trade works a little bit differently with the strategy option. You can see here underneath strategy, you can pick all kinds of different things. This is already pre-set up to a vertical. That's the one that it automatically sets up for you. And you could set it up as a short call or a short put or a long call, which would be a buy debit spread, what I typically do. Then what I could do, if I go ahead and say, let's just for fun, let's set up the same trade. I'll let you guys guess. So let me do, instead of doing 1 day today, let's go to September 5th.
Folks, I'm going to just pause this presentation for just a second because there's a lot going on in the chat that I need to address. This is a recording that we're replaying of Nathan's lesson on debit spreads from earlier this month. This is 3 weeks old. So please don't be taking these trades for real right now. This is just for educational purposes. And not to sound like a parent, but you know, if you show up late and then just start taking trades you see on the screen, you're going to get yourself in trouble. You need to make sure you're here on time or that you ask questions about what's going on, because we made it very clear that Nate and Graham are out today. We're replaying a lesson from earlier this month, and nobody should be taking these trades under any false pretense that this is a live presentation. So please show up on time, or at least ask questions when you get here. Make sure you don't get yourself in trouble. We don't want a lesson that should be really great for everybody's education to turn into you losing money because you're, you know, taking trades that we're not intending you to take. All right, we'll get back to the lesson.
And set up the same trade. And you guys guess. The last trade cost 2 pennies. Let's go to the same expirations. What do you guys think the difference will be going from 1 day to 1 month? Do you think it'll be twice the cost, 3 times the cost, 5 times the cost? How much more do you think we'll spend on the extra time that we're giving it? Well, John, it's only a dollar spread. So the most it can be worth is a dollar. Keep that in mind. So let's see. What did I just trade here? I forget already. I traded 634, 635 for 2 pennies. Okay, so let's go ahead and set this up and go down to the 634, 635. And you guys can see this is going to cost us now about 30 times the price. About 30 times the price buying 1 day of value versus 1 month. Why? Well, like I said, the market's not dumb. It knows it's very unlikely the SPY is going to move up 1% today, but it's pretty likely the market can move up 1% over the next month. So we are paying for that extra time. Ted, you're right, but there is a curve there, because I'll bet you if we go out 3 months, it'll be more expensive, but it won't have nearly the same ratio. In other words, it won't be 90 times the price if we go out, because there's a shallowing curve. Let me show you what I mean. So instead of September 5th, let's go to January 2026 and do the same thing at the 6th. Oh, I can't do single dollars. All right, hold on. Let me go back to when I can do single dollars on to give you an exact example. Let's see. Do we have singles here? No. Do we have singles here? No. Let's see. Do we have singles here? Yes. Okay. So let's go to the 634, 635. You can see it's barely more because the curve flattens and the time doesn't matter nearly as much once you get out further in time. So the short dated, going from 0 days to 5 days to 10 days to 30 days, is a much more expensive option. But as you get over time, the pricing really flattens out. All right. So hopefully that makes sense. Guys, by the way, this is a great way to learn debit spreads. Literally coming into the options chain, looking at different expirations, setting up theoretical trades, and looking at them in practice is actually a great way to learn. And I highly recommend it. So let's go ahead. Let's set up our same trade, but go out a month, and then we'll track them. We'll keep an eye on them together. So this one's going to be about 50 cents. This one is less of a donation because it actually has a decent chance of winning. I'll set that. And now that is a working order attempting to be filled. Okay. So that's on Tasty Trade. Now, let's go over to Robinhood, because I also put a couple $100 in Robinhood because I got lots of questions about how do I set it up in Robinhood. So I'm throwing money at different accounts so you guys can see different examples. So let's do the same thing. Let's go to SPY. Let's go to Trade Options. That's where Trade SPY Options. That's where we see the same exact thing, right? A little bit of a different format here, where your expiration, your time horizon is going to be up here, and then your strikes are going to be down here. Now, Robinhood has 2 options. You can use today's expiration. You could buy one and then flip over to the sell side, and you can grab another one and set up the trade like that, where it will do it for you in a similar structure. Or you can use what they call their builder option. And their builder option is going to be the one that pre-selects them for you. So again, vertical spreads, we are looking at call debit spreads. You click call debit spreads, and as you can see, it's going to set these up for you. 622, 623, 633, 634, etc. It's going to build these for you, right? So you can also, by the way, choose your strikes, where you can go to wider or shorter strikes. Let's go to tomorrow's expiration and do a defensive one. I'll show you how much more expensive it gets if you go below the money. So the current price is 630. If we come down here and we go $4 or $5 below the price, you can see it's going to be a lot more expensive option. You know, we paid 2 cents for one way out of the money, but we're paying, 84 cents or so. It's like more actually like 85 cents maybe for one out of the money. So again, this would be one where you're getting below your line in the sand. And that's how you would submit it using the builder. So that's 3 different brokers, 3 different debit spreads with different times and structures, but all using the same concept with different parameters. And that's really what I'm hoping for you guys to get more and more comfortable with as we go along. I will, teach you guys strategies, obviously, give you as big of an edge as I can, but hopefully over time, oh, look, I'm down $1 on the day. My equity curve doesn't look very good. But hopefully over time, you guys will get more and more comfortable with those structures and be able to set them up and use them in a way where you understand what you're combining with different, risk rewards, different time frames, all that kind of stuff. Okay, now another thing that I want to mention, folks, is if you want to learn some of the deeper nuances here, which I hope every single one of you want to do, you want to join Opening Playbook. That's the $1 lifetime subscription. The reason we charge $1, we wanted to make it free, but they said to put it in the members area, we had to charge something. So we charged $1. That's where you're going to get all of those other things like I mentioned. So you're going to get the why I use early exits. You're going to get the why I never use stop losses. You're going to get the calculators that show you how to set this stuff up. You're going to get the recordings of previous sessions. You're going to get the trade tracker. You're going to get all the different things that help you utilize the foundational trades that we talked about today if you are a member here for the $1. So again, I would give it to you for free if I could. I can't. We had to put it in the members area. That means we had to charge the least amount we could. And so we had to give you, the $1 order form to secure your access inside here. So I do recommend that. Dave, I don't know if we already have like a quote unquote CTA pre-set up for the Opening Playbook VIP. We should probably get one, but for now, maybe we could just grab that link and post it in there for folks. If you want to join that $1 VIP, that's where you'll get all of that. So I'll give Dave a minute to grab that link. We'll post it in there in a couple different places for you guys. But before we move on, it already is 10:50. I promised we would talk about overnight options. So the first thing I'm going to ask in the chat, guys, let me know if you hit your target either today or hopefully both. If you hit your target on overnight options yesterday and today, one with a down day in the market, and so far today with an up day in the market. Thank you, by the way, for all of you guys who sent me those emails. That was awesome. We are hitting these targets on a really consistent basis on overnight options. Kevin made $1,800 today. Diane both days. Debbie both days. Green Farm Cat both days. Elena both days. Charles, Silvana. Okay. Deb said not yesterday. Okay. Shrita said yesterday. Ron said yes. Kevin said yes. Jerry said yes. Brandon said yes. 17.5. Nice. Yes, both. Okay. So what we're going to do is, okay, Katura both days, Browner both days, Edward both days. What we're going to do is we're going to give you another opportunity on overnight options, because I don't know if you guys saw this. I actually had Blake go live. Did anyone join Blake in Evening Edge yesterday? I gave Blake some notes yesterday going through that trade. Hopefully it was valuable. I wasn't able to join live, but I wanted to show how crazy it was, how ugly the day yesterday looked, and we still hit the target on a bullish trade, which is, even though I've been doing this for over a year, it still kind of blows my mind every time we hit those winners on really ugly days because we're in a bullish trade. So that puts us like 22 for the last 24, racking up a lot of wins. And I still had tons of people emailing, even after we talked about it yesterday in Opening Playbook and after Blake, saying, Nate, I'm still not in. How do I get in on overnight options?
All right, folks, we're going to switch to the overnight options. replay. Again, this is going to be a replay of the previous promo for overnight options, but the offer that's in here is still good.
Now, the majority of trades today are from back-tested data, unless otherwise stated, in order to demonstrate the potential of the system. Now, on the back test, the average return is 5.3% overnight. So in 24 hours, you get to do that multiple times per week with an 89